Good afternoon, everyone. BC Richfield here, coming to you live from London. It's just gone midday UTC. Big shout out to everybody joining the stream live today, and also for everyone that is watching this on recording. So, heading into the Christmas period, it is the Christmas lead in. I'm a massive fan of Christmas. I don't know if you guys are as well. Great time. Love to spend some time with the family. So super excited about that. Obviously, the markets are closed, traditional markets, that is as well over Christmas, obviously not crypto. But we can expect quite often, for that to bleed into the crypto markets as well, right? So we're not expecting too much. It's a good time to kind of refresh over Christmas and take stock of the year that we've had and look to really get into the new year, and really, really smash it. We've got our 5th-year anniversary coming up as well at the Bird Nest, which I'm super excited to be a part of. Very proud of that, which is coming up on the 27th. So do keep an eye out for that as well. And look, what I want to do today is I want to do a short, sharp stream. I know I say this every week, just looking at the price action, seeing where we are. And I want to kind of bake into the fact this idea, which is something I do use, and I've been a bit lax in terms of sharing it recently, but that's around divergences. Lars, Martin, you have a Merry Christmas as well too, my friend. Thank you very much for joining the stream. And a hugely Merry Christmas to everyone out there as well. I know not everybody celebrates Christmas, but whatever you're up to, I hope you have a fantastic festive period and use it as time to really rest and replenish, because in 2023, it's going to be a very, very big year, right? For a number of reasons, but I'm really, really pumped about what we've got coming up in the new year. We've had a fantastic time this year with the people that we got. We're very lucky to have in our community the traders that we've got. And it's been a really, really cool year. It's been a very testing year for a lot of people, myself included, but a very, very positive one at the same time. So I'm really looking forward to celebrating it with family and then really getting back and just aggressively going at it next year and trying to achieve some really, really big goals for myself, our students, our community, and everyone else. So before I digress too much, which obviously I have a massive tendency to do, as long as everyone can hear everything okay and the charts are all nice and clear, I just want to start with a nice naked chart today and really look at where we are, my thought process, and how I'm seeing things. All right. So first of all, I'm just going to really zoom out for you. And what I've got on at the moment is my B Pro for divergences as well, right? And what you'll notice with a lot of divergences, obviously they're a lot less frequent on a weekly scale, a little bit more so on a daily, and obviously more so as you head through the time frames, down through the time frames, is that we can see here that in this case here as well, right? This case as well, they're catching the corrective moves in an ongoing trend, right? So what I mean by that is that the trend here is clearly down, right? And we can see here that these divergences that are picking up are catching these corrective moves. Now, we can trade those. Never going to trade these things alone, by the way, guys. So we're always just using them as a point of confluence and to help with our bias. And I just wanted today just take a look at that and really kind of explain to you how I piece together this bias. So if you've got any questions, please do ping them in the chat as we go along. If I'm speaking too fast or if anything becomes unclear, or because maybe due to the time of the year, the internet's been a little bit twitchy recently, even though we're on business fiber, do let me know if there's any disconnect between what I'm saying and what I'm showing on the charts, all right? So this is a key level for me. This consolidation here, or this last down candle, large volume down candle before we had this huge expansive move higher. Are we going to get there? I don't know. I've assumed that we have for quite some time. These key levels do like to be retested. And obviously in a market selling off with these conditions, we now find ourselves not too far away from that. It sits in around about 12K. Goncalo, thank you very much. Good to know it's all nice and clear. So I like starting on a weekly scale. I wanted to zoom out a little bit just so that we can give it some context. But really what we're looking for here, because of the amount of data that exists in the candle, is we really want to kind of zoom into this, all right? So I'm looking for liquidity, right? That's how I look to trade. I want to see key liquidity taken, and then I'm looking for reversals, or I'm looking for relief, and then I'm looking to pick myself a point at which I can get back in the market with the trend, okay? So just to mark these up quickly, this was a very key level for me. Right, we can see as we've run this liquidity here, price has really punched through that level. Now, as we extend this level across, we can also see that price is failing to reclaim it, right? So for me, that has a level of significance in the same way that when we set this low back here, that had a level of significance as well, right? We see as we travel it through to here, price came up, tried to get below it, couldn't, got bought up, bought up, bought up. You notice how these candle bodies are getting smaller and smaller, the smaller volume, right? Then when we have this pump up to here, and obviously, designed, or how the markets work normally, whatever your belief is on that, to generate liquidity, what we need to realize is the liquidity resting above all of these highs. So we've swept that here, that gets swept. Then the liquidity that's now generated above here, it gives a prime opportunity for price to run up, run the stops, generate a lot of liquidity there for an aggressive sell-off, which then comes back down to these lows. Now, one thing that I did expect when we got down to these lows was a little bit more of a reaction to the upside, right? Because there must be a lot of liquidity resting below here. And whilst price really punched in through that, if there was any bullishness in the market here to push up, you'd expect that to be taken down here. Now, we didn't see that. We didn't see that key reaction. But what did we see, and what do we want to be aware of on a weekly scale? So for me, first and foremost, I want to be aware of our mother bar pattern, okay? So this is an inside bar pattern, and this becomes the mother bar. So let's just draw this back over here. Okay, because we've run that level now, so we know where that is. So an inside bar pattern is where we have the first candle, which is known as the mother bar candle, right, is the second candle. When that candle closes, the high and the low of that candle have to be within the high and the low of this candle, right? So that then basically becomes the inside bar, right? Or in this case, an inside week. This is a sign that the market is looking to slow, or there's potentially a consolidation coming, or that there's a potential reversal, right? It means that basically we've hit this point of consolidation, of indecision, and then we're looking for price to reverse. Now, how do we trade these? So we, first of all, this is our larger range, the mother bar. And then this inside bar here, I'm going to take these lines completely across because they're still of significance. This inside bar here then becomes our internal range, okay? Now, as with any range, our theory is that if we run one side of the range, and fail to close outside of it, when we come back inside, we then target the far side of the range, right? So when we did this and we came outside of this here, we ran the liquidity above this, natural to assume that we would come back down to test this side here, which we didn't, right? Trading isn't perfect, and there's no point listening to people that tell you that it is, or tell you they're nailing every trade. All we're doing is we're building a theory, a story as to why price is going to move, and we're making sure that we have a strategy that's repeatable, and we're looking to win more than we lose. Or if our win percentage isn't more than we lose, well, then we need the risk to reward to be so high that it allows us to be profitable, okay? So obviously we would look at this on a lower time frame, but like I say, the theory is we run one side of the range, we head to the far side of the range. Now, one thing whenever I'm range trading, that I'm very aware of is the equilibrium, right? That's the 50% line, because what you'll often see is price run a level, come to that. Once it finds acceptance over that, then we expect to push to the far side of the range. Now, obviously, we didn't get that here, right? Price hadn't quite done its business in terms of wiping out the liquidity. We took out these equal highs here. Okay, so we left a big liquidity pocket there. Price ran up here, got a lot of people bullish, and then rejected back down. So let me just remove that for a second so we're nice and clean. So this is where we are on a weekly scale. Now, once we had this run on liquidity here, price came into here and opened. The close of that candle confirmed this 100% bullish divergence. Now, the B Pro is slightly different to a lot of divergence indicators because it takes it off of, I think, 10 or 11 different oscillators, right? So this is a combination of all those different oscillators, all those different divergences. So the higher the percentage, the more confluence that the different indicators or different oscillators are calling for the same divergence. So this meaning that all of them are when it's 100%. So that's very strong. So how does that affect our bias? Well, it says to us that we've run liquidity down here of the lows, not just of the inside bar, but also the mother bar, right? Now, when this candle closes back in this range, what we're looking for is this candle to open, trade lower to come down, generate liquidity, before it then makes a move to take out, first of all, this week's high, and then the high of the inside bar, right? So even though we say to ourselves, and a lot of people say this to me when I'm giving these examples, they're like, yeah, but once you're back in here, you've missed most of the move. There's not far to go up. There is still plenty of movement, believe me. When we're looking at this on a weekly scale, that's an entire week's move. So when we go into this, we're going to decant this down onto a daily, then onto a 4-hour, move through the time frames. We'll see the opportunities that it gives us. But just so you're aware, I'm waiting for a liquidity level to get swept, price to let me know if it's confirmed the sweep, in which case I would expect a strong close below this level, right? If it then comes back within the range, when it's back within the range, right, we then expect it to travel to the far side of the range. So when this candle opens, that's where we get our tradable week from, right? So let's just pop a little arrow on that there, right? So that we're aware of that. That's where we're trading. We've got our key target. First of all, the weekly high, right? And then the inside bar high, okay? Now, what else do we need to be aware of? What else am I aware of on a weekly scale? For me, I want to overlay the same methodology in how I'm looking at the charts, how I'm analyzing them across the different time frames. So I'm looking for key liquidity levels. I'm looking for inside bar patterns. I also look for the way that the candles open and close, right? Particularly long wicks can be telling if we get patterns such as hammer candles, if you get pin bars, or like in this case, you get your engulfing candles. They all tell us a story within themselves, which we'll elaborate on a little bit as we go down. But something that I'm always looking for are our market inefficiencies or fair value gaps, which ICT would call them. So as we look here, let me make that a slightly darker shade so you guys can see that. This is our fair value gap, right? Now, this is where the market has sold off aggressively, and it works the same when the market buys aggressively as well. It leaves this inefficiency. So the inefficiency is, we judge that from a 3-candle pattern. Candle 1, candle 2, candle 3. If there's a gap between the wicks of candles 1 and 3, that's our inefficiency, right? So this whole level here, right? Till we get down to this wick. That is where our inefficiency is, okay? Now, the cleanest way to think of this is that the market needs to be efficient. It wants to create a tradable environment. So the market will look to rebalance this inefficiency, right? So if we look historically, we can see we had this inefficiency here. Just to give you a couple of quick examples, I'm not going to make this a big teaching lecture today, guys, but inefficiency here, yeah, market sells off, comes back to rebalance this. When that's rebalanced, we have confirmation, and then price looks to move lower, right? Where else do we have it? Obviously, we have this inefficiency here, right? And we can see that it didn't fill completely, but price did come up, was drawn back up to this, takes out the liquidity above these highs. We get our bearish engulfing candle, and then price sells off down to these lows, okay? Now, again, with the power of hindsight, it's very easy to make these things sound simple. It's very different to do them when you're trading them live, all right? But that's the key things that I'm looking for on this scale. So we know where our key liquidity level is. We've seen that get swept. We then mark up our inside bar pattern because I don't want to just trade this blind. I don't know if this is going to purge lower down into the liquidity that's sat here, or if we're going to get the reversal. So what I want to do is put a set of parameters out, a set of levels, that if they're getting swept, if they're interacting with, that's when I become interested. And then I'm looking for entry patterns. So we're now going to drop this down onto a daily. All right, and we can see on this level how effective the majority of these divergences have been, right? So again, we're not just looking to trade divergences blind, right? What we're looking to do is we're looking to plug them in as part of our theory, all right? So if I just turn these off quickly. So when we get to here, right, and obviously this is bullish, right, as we're coming up. So we've just had this big spike up, and then prices started to sell off, and then we enter this large consolidation here, right? And again, I'm not going to kind of dwell and go into these points too much, but if you were looking, for example, and depends if you take the wicks or if you allow for the bodies of the candles, right? So if we're taking a volume range profile of this, we're looking at the lowest bodies to the highest. And what we're looking for here is our power of 3, right? Which is consolidation, manipulation, and distribution. Okay, so that's where price is consolidated. It makes a fake out, deviation, or a swing fail, right? In an attempt to get out, to generate liquidity, to get people long. And then you get the swing fail, price comes down, and then it distributes to take out all of these lows below. Okay. Now, what can help us define these type of moves is again looking at how the market is looking to rebalance. So when price started to move up to here, something I was very conscious of when we got this move was this fair value gap. Okay. Now, obviously, again, this is easier with the power of hindsight, but we're in an overall high time frame bearish bias. Yeah. That means that if we're looking to trade with the trend, then we're looking for bearish setups. That doesn't mean that we can't trade these up into this, right? And when we get down to here, it doesn't mean that we wouldn't necessarily look for bullish price action to pull back up into this inefficiency. And for those of you with a keen eye, or if you've studied this kind of thing with me or with anyone before, right, then you can notice that you've got another inefficiency here, right? So again, price getting drawn up into that level. So henceforth, why we were looking at bullish trades here, okay, because we've taken out key lows, we've come back within this range, and then we're looking to move higher. So what we're doing is we're just decanting what we're doing on a weekly scale now down onto a daily. So I wanted to show you this because when we're looking at divergences, right, what it can help us do is gain context and also trade plans. So if we're looking for key lows to be swept, so we've got a swing low here, right? So let's mark that up. Then when we come down, we set the liquidity below here, which I won't mark it on just for the sake of it, but these are equal lows, and you can see how they were just tagged down there. Yeah. And then what we're saying to ourselves is as we're moving up here, we see these equal lows as price comes into them here. And then we obviously have this high over here. Now, why have I marked these levels out? Because from a price action perspective, this is where I'm starting to get interested in the market. And we will focus on some recent price action shortly, but I just wanted to show you this. So as we're coming into these levels, sometimes we need a little bit more conviction, right? So I know that when I'm not saying this with me, but people that I respect massively in the market, when you watch them talk, they do it with such ease. And a lot of the time it's obviously on historical price action, right? So we have the power of hindsight. However, when we're looking at them, I appreciate, and I certainly remember during my journey up, I was really struggling to trust in the price action, right? Because for me, it just seemed like these candle patterns on a chart, what was creating this? Is the market being manipulated? Is it these smart money concepts? Is it just the way that human psychology works? And this is reflected on the charts. Is it institutional manipulation? So you have all these things whirring around in your head. So anytime you can get extra confluence, and you obviously make sure you really back test the living hell out of it, right? But when you get that extra confluence, it can be really helpful. So what am I waffling on about? I'm saying that anytime we get to a key high or a key low, yeah, like we did here, we came to these key highs, price interacted with them, everybody got bullish because obviously we'd broken market structure on a daily scale. Again, I know I'll end up sounding like a broken record, but we had this fair value gap here. That's what was drawing price up. When we then took out these highs here, right, then we need a little bit of extra confirmation if we're going up to take out the liquidity above here, or if this is purely like a deviation from this level or a fake out, a swing fail, before price then looks to aggressively sell off again, all right? And at the time, we obviously don't know that, right? But when price gets up to here, when price gets here, when price runs these lows, divergences can quite often help us, right? So we come down into these levels, we run up here, no divergence. So we break down. Let's say that's a really key part of our trading information. So fine, we missed this sell-off. However, when we come down into these lows, we sweep these lows, we get our divergence here. So where does this allow us to trade to? When we get the divergence, we're simply looking to trade to the key swing highs that we see. So we've got this swing high here, which if we draw that along, we can see that price has taken liquidity of the lows. It's now searching liquidity higher up. So people that have bought here, smart money, as people like ICT would call it, institutions, hedge funds, right? It sounds really simple, everyone, right? But smart money or institutional money, they want to buy low and sell high, right? It sounds like one of the most ridiculously simple things to say, but it's true. So when we come into these levels, and we've got acceptance here, prices run down, we've seen a key liquidity sweep after a big sell-off, we've taken out these lows, we get our bullish divergence here, yeah? And when this candle closes, we notice that it's closed back above this liquidity level where we've swept. For me, if price was ready to move lower, I would expect a strong close below that level, which granted was something that was very tricky about this move here because we had this really big bullish close above here. But we'll take a look at that in a moment and say what techniques we can put in place to avoid those. However, one of the most important things we need to accept as traders is that we're going to lose. I know traders, exceptional traders, someone like my good friend Pedro, who works at the Bird Nest with me as well, runs unbelievable automated systems, builds algorithms, one of the smartest people I know. He's got systems that was win rates in the 30-35%, and they're absolutely killing it, right? So again, it comes down to understanding your strategy, but a lot of people become unstuck trying to find that, that unbeatable entry or whatever. It isn't out there. We have to do these things consistently and with time, and over time, that's what makes you a profitable trader, is the consistency. So before I digress too much, let's look at what our divergences have done for us here. We ran these key lows. The divergence gave us the heads up when this candle closes, and we have to wait for the candle close, because if you take it when it pops up on the candle before the close, it can invalidate, right? Meaning it will be there 1 minute. If price continues to go lower, then it can change, all right? But this candle closes, comes back within our liquidity level, right? Gives us the confidence to say, okay, we could be looking for relief here. So where could we find relief? Above this high or above this high here, all right? So we get nice trades into this. When we sweep this level, and price starts to sell off, right, we haven't had our divergence, right? And if that's a big part of our strategy here, we're saying to ourselves, okay, well, we need to hold off then. We see this purge again, and what happens here? It takes out these equal lows here, and the liquidity sat below them. What do we get? We get this beautiful hammer candle, like a big pin bar. And then that wick, that downside wick there, tells me that we've got a lot of buying pressure, all right? So when it closes here, we can see it's well back within the range of this. We've got our divergence. Price opens here, and we're looking for entries in this area here, targeting these key highs. So quite simply, we're saying when price runs liquidity below a key low, it's then looking to find liquidity higher up, all right? It's when it trades to here. So what we also noticed is when we took out this high, this divergence helped us get into the trade down to these lows. When we came up into this high, we took this one out, divergence here, bearish engulfing candle, great reason to enter, first target, second target below these lows, and then ultimately we've got our weekly level here, all right? So we can use these things as confluence. What we don't want to do, and I see quite a lot from people, is saying, right, bang, we've got a high time frame divergence, I'm short, right? Let's use it to plug it into data and add to part of our theory. But, for example, this divergence we got here, price drops right down, comes up, closes, confirms this divergence, right? But what have we done? Right? We've come down, we've taken out this level, we've got our divergence down here. Price comes up. We don't see any movement to the upside, right? What actually happens is the candle opens. Let me zoom in for you. Candle opens, trades up, right? So we'd be thinking, okay, well, if that divergence is accurate, what do we want to see? We want to see price draw down for liquidity lower before it moves back up. TA23, hey, bud, thanks for joining the stream. So, like what we see here, we get our bearish engulfing candle after our divergence. We then want to see if we're bearish, we want to see price draw up, which it does here, right? Let me zoom in a little bit for you. So price opens. The day opens here. Price draws up first before it sells off, comes back here to close. This day opens, draws up first to generate liquidity, and then has a huge sell-off. This day opens, draws up for liquidity, has a large sell-off, right? Now, if we're expecting bearish continuation here, we notice here that price opens, trades down first of all. So it's reaching down for sell-side liquidity, right? Liquidity at the lows before it then comes up and it closes, right? So that are all things that we would focus in. That's why we look so closely at the daily open, okay? But when we're looking here at the divergences, even if we were to take that one and say, look, well, we've run this level here, right, as we draw this across, we've got our divergence, we've closed back in the range, right? So we're thinking we could be looking at a bullish reversal here. What keeps us out of it is how the day opens. So as it then trades up and sells off aggressively, that's fine because we're already in bearish positions here, or we've had opportunities to get in on these days here and here, right? So That's our theory. And if we plug it in with key levels, then we can really, really start to do some damage, right? Because as we see here, run the level, here we get our divergence, price pushes up, run this key level, divergence, fine. In this case, unless we were scalping this, price comes in here, closes back below our liquidity level, so we would be looking to scalp this lower. But in terms of targets, like we said on the weekly, we want to make sure that we're not overextending ourselves here, especially in current market conditions when we're looking at beta risk assets like Bitcoin, right? That can be moved around so aggressively. And that's before you start getting down into any of the alts or low caps, right? So all we're doing is when we have this, we get our divergence, price closes, we're looking for these days. Where are we looking to trade them into? We're first of all just targeting the prior day's low, right? Or the prior day's high. That's our kind of our key target, our low hanging fruit. Again, that's a British term, so ICT uses it, but I'm afraid I'm claiming that one for the Brits. But it is very much a term that he will teach, as will a lot of other great price action traders. Make sure that your targets are realistic. Better off hitting smaller, closer targets consistently than it is holding for positions too long and risking that loss. All right. Now, what else could be drawing price down here is our fair value gap, right? So we're saying to ourselves, we're telling this story. We've run liquidity, yeah? This is obviously our high time frame, our weekly equal highs here, which come into play over here. We've run liquidity, we've closed back within this range, right? We've now closed. Now we're saying, okay, well, if our bearish bias here is correct, we've closed this divergence. What do we want to see? We want to see price open and sell off. What we get here, price opens, yeah, actually comes down first of all and takes out the sell side liquidity before it moves higher and then it closes. Okay. So what we're waiting for is the opportunity for price to open up and then sell off. And sometimes it doesn't work, as you can see. We actually would have been a little bit early on this one. We probably would have got a decent scalp trade in here. But what we see here is price actually came back up to run this again before coming back down, and then it came to take out these lows. All right. So divergences, when they're used in this way, can be really, really handy. Earn money online. How you doing, bud? Hello. So that's what we're looking at there. We popped this arrow in here in terms of our weekly bias, saying when price closed back within the range, this is when we'd started to get bullish. We can see we get our engulfing candle here. That's a sure sign that as the day closes here, we get this little retracement and price starts to pump. Now, 4 hour is the time frame that is the lowest time frame, sorry, that I'm willing to use divergences on, because below that it all just starts to get a little bit too choppy, right? Now, how I would use these in line with the high time frame levels, sorry. Let's just do this quickly as well, right? Let's just pop a little marker on the start of each candle. So we're bearish here, we were bearish here, and then we would have been bullish here. We're obviously bullish here as well because that's our weekly level. I'm going to go back and change these to green in a moment. Okay, so does everyone understand what it is I've done there? So basically, these green ones that are going on. Burned, hey buddy, how you been? Merry Christmas, bro, and to everyone else on here as well, or happy holidays, depending on what you celebrate. Hope everyone's got some lovely time off planned with the family to refresh and come back ready for next year. So all we've covered here is this is our weekly one. So this is why we've put an allowance for this on here. So from this candle's open, we're ready to trade it. The reason there, the candle after the divergence is because we need to wait for this to close, right? So let's look at our confluence. We're running a key level. Let's not forget as well, this is our inside bar, right? Here. But this also becomes an inside bar pattern of its own, this becoming the mother bar. But we won't go into that much detail on this. Like I said, I'm not going to go over that too much. Just going to kind of look at it in terms of what it is. So this is our inside bar from the weekly, and this is our mother bar, right? So we've run a key level. We get our divergence on a daily scale, yeah? So from this candle onwards, we're bullish. This is our weekly one. So from this candle, we're bullish. We run a key level here, divergence, we're bearish here. We run a key level here and these equal highs on the weekly, divergence, so we're bearish here, right? Now, here's an interesting one, right? So we haven't run a key level here, yet we have had our divergence. The other thing that I'm thinking here is as we've come down and we've filled this inefficiency here, what do we have here that could be of prominence? Right? Which is our order block. So I'm just going to write this in. And again, order blocks and stuff like that, I will use them on lower time frames, but I am favouring these. So OBD means it's our order block daily, all right, which we know is this black line. So we favour things the higher the time frame, right, in terms of the weight that they hold. That's certainly the way that I look at it. So I hope that's clear so far, guys. Annika, happy holidays to you too. Bernd, Merry Christmas, you legend. And Annika, thank you very much for the wishes. Happy holidays, everyone. So key theory is we look at our high time frame bias to judge where we believe the market is heading. Then we're looking for our key levels to be run. When they're run, we look for our divergences, right? When the divergence closes on a daily scale, which is why we've got these dots up, we're then going to decant this down to a 4 hour. Right? And then we're saying to us, okay, what other confluence do we have here? So we can see as we come into this level, right? We've not only run the inside bar, but then we run the mother bar as well. Okay. So we don't get a 4 hour divergence here, right? But we've run two key levels. So that could be our chance to enter. However, if our strategy says that we require a divergence here, and don't worry if it does, don't ever worry about missing trades. And unless it becomes a consistent problem that affects your overall P&L, you're going to miss trades, right? You're going to miss trades, you're going to lose trades. The sooner you're able to come to accept that, the much better trading will be for you, all right? So we run that. So say we didn't take that trade, but we've got our weekly bullish here, right? Now, the other thing that I'd be looking at here is saying, okay, this is of interest, right? We've got our 4 hour fair value gap. So as price takes off here and breaks structure to the upside, this then looks to retrace, right? The retracement, we're bullish from this candle, remember? So from this daily open, we're looking for price to retrace and then sell, and then buy, sorry. So we then get our divergence here on the 4 hour. So from this candle, we're tradable, right? So we're live from this candle. We would be targeting these highs first of all, but ultimately the highs of the inside bar. This becomes interesting because this then becomes a target, right? Can you guys all see that? Okay, let me make that a little bit. In fact, why not? I'm going to make that teal. So our 4 hour fair value gaps are going to now be in this blue, all right? So we leave this inefficiency, price comes up. Now, when we get bullish here, we want to see price draw back. Now, price is drawing back to this fair value gap, right? The other thing that we can do, if we want extra confluence here, is we can draw our fibs, yeah, Fibonacci. We're taking that from the low to the high of the move. Now, there's two things I'm interested in here, right? One is whether we're in discount or premium. Yeah, so let me just draw these in for you very quickly to help kind of get this concept. This is something I learned on ITC's original membership, which is from 2017, which is a concept that I absolutely love and I use it every single day. Right, so this is our range. This is premium, this is discount. We want to short in premium, we want to long from discount, right? If we're thinking of this as a trading range, what we're saying is you want to be longing from this position here. You don't want to be longing up here, right? Because this is the high that it can get to potentially, in which case your risk to reward is going to be horrific. If you want to short up here, then you know you've got a target of the 50% line, like with any range play. But if you're longing, you want to see price down here, right? In a discount, meaning that you're buying at a discount and price is going up. If you're shorting, you want to be shorting from a premium. So I hope that makes sense, guys. To be honest, I would always just recommend that if that's something that's of interest to you, I'm happy to cover the basics of it, but I'm not the originator of that content, right? So I would go and study ICT stuff on that if that's of interest to you. And I would recommend probably his 2022 membership, which he does that he does now. So can you see how we've built confluence there? We've got a fair value gap that we believe is drawing price. We've also in a bullish trend here based on our divergences on a daily, right? We've not broken a high time frame structure here. We've now come down. This can be setting our higher low, yeah? We've drawn down into the fair value gap. We have a weekly divergence here. We now have our 4 hour divergence here. What else do we have? And I mean, obviously these things, you don't want to confuse yourself, right? But these things are about building confluence, right? This is the other thing I love here. In this price leg, look how we're drawing down towards the 618. Yes, it would have been lovely to have tagged in the golden pocket, right? Which is the 618 here. But we can see as price comes down, look how it respects this 0.5 level, right? And this, basically, in terms of volume, is our SR flip, right? Price comes down, sets this, sets the low, breaks out to the high, retests this level, and this is where price then buys from, right? That's where we get the buying pressure step in. So when price revisits this level, if the buyers stepped in here, we can make an assumption that they're stepping in here as well, all right? So that's the story that we're telling. So let's look at the other ones quickly as well, right? So again, we know we're bearish here. So what do? We come in, we've got our range here that we can see is developed from the low to this high. So we run our range. Once again, let me just draw this across a little bit here. And we would obviously move this up to here once we'd passed this, right? And what we can do is obviously when we set this initial high before any of this price action takes hold, this is the high that we respect, right? Because that's the high that's been set. So we're saying now, obviously we're in the top 50%, yeah? So in this respect, we're saying we're in premium, meaning we're in shorting territory, right? But we get our divergence here. We see this is the candle at which we've got our confirmed daily divergence as well. Price comes back up, potentially gives us some entries here. But as we look to scalp this short, I imagine we would have fallen short of any key targets and we would have taken a loss here, right? Because price just simply wasn't ready to move then. However, when price runs up and takes out this key high here, and we're still bearish, we get bearish on the high time frame. Remember, we haven't broken that trend. We come in, we have our divergence here. What happens? We set a doji candle, and then from here on the lower time frames, we can look to scalp into these lows, right? We've got a key low here, a key low here. If price is looking to generate liquidity to move higher, this is where it's going to target to do so, all right? So we've taken a 1R loss here, right? We've taken the thing on that. This is brilliant. Diggs, hello, mate. Hey, what's up to you? And this is brilliant. Please speed it up. It's getting boring. Yeah, I'm really, really sorry. It's not always the most exciting thing trading, unfortunately, but I do apologise if you're not finding it the most riveting, mate. I will try it. Normally, I get accused of going too fast, so just trying to make sure people can kind of understand it. So our basic story, right, that we're telling here, people, is that if we've got these, which are marking out our high time frame bias in terms of what we're getting with our divergences, right, then we're saying to ourselves, we were then waiting for our 4-hour divergences, runs on liquidity, and our nice internal targets, right, which are here and here. And we can see this get swept, right? So once again, as we look over here, we've taken out the equal highs on a daily scale. This is our sweep, right, on the 4-hour. We've taken that liquidity there. What happens? We get our divergence, bearish divergence confirmed here. We get the confirmation on the 4-hour scale as well. Price then has this beautiful sell-off here, which takes out these lows. It leaves this fair value gap, which price trades back up into. And then where's our next realistic liquidity? Below these lows, right? So that's what we start to target as price drops down, drives up. We leave the inefficiency, gives us the opportunity to enter here as we draw down into this level. Now, in terms of talking about recent price action, we're bullish from here, yeah? Thank you, Annika. I do really, really appreciate that. I know different people, different levels. I know I can waffle a little bit. I do try and make it inclusive for everyone. And just a quick question here as well from Visos77. What are the green and red circles? Okay, buddy. So these are daily divergences, yeah, using our B Pro indicator. So this is when we've had confirmation, and this is the daily open, yeah. So the confirmation for the daily divergence has happened in the prior day, and then we're using that to play in to our theory in terms of where we believe price action is heading. So to say that very quickly, we get this divergence here, right? So we back that up with a 4-hour divergence. We're then looking for price to sell off. It breaks structure here, leaves this inefficiency, which we trade back up into, all right? And then we can move on to the lower time frames to find our entries. But the key thing is we're saying this day, right? Until we take out these key lows, so let me mark these in, right? Until we start taking out these key lows, we're retaining this bias, right? So it's not just that we have to take one trade at the top here, right? And then say we hold this all the way to the bottom. This gives us opportunities to get in here on the Thursday, gives us opportunities to get in here on the Friday as well. I don't personally trade weekends, all right? But if you do trade weekends, and you can hold that bias. Now what we've got here is this level, this black line is our daily order block, right? And we can see how well respected the volume of the candles has taken that on, right? So we had our confirmed divergence daily on this day, right? And then we get a bullish divergence on the 4 hour here. So from this daily open, yeah, we can trade this. And before we close up, I just want to give you a quick look at how that would look like, all right? Just so that you can see everything's transparent. Like I say, the way that I trade is the way I trade. It's a very simple way to look at the markets. I found it effective over the years, but I'm not saying to copy this or that. I just hope you guys find something of any kind of insight or use out of it. All right. So this represents this day confirming our bullish divergence, right? Now, what do we want to see? Right? What we want to see is we want to see a shift in market structure. Now, you can do this on the 15-minute, you can do this on the 5-minute or lower, right? But what I would say is I would be looking for the market structure breaks, right, or shifts on the 15-minute. That's how I do it, right? So for me, I classify this as the break. Okay, so that's our market structure break. When I'm looking down here on the micros, I'm seeing this come up. We've set this high here, right? It's a swing high because it's got candles either side of it that are lower. So that's what I'm considering. This is when I'm getting interesting, when I'm seeing the shift, right? So you notice you come down, set the low, set the high. Higher low, this now comes up and sets a higher higher, right? Now, the reason I consider this the break is because this is the prominent higher. And as we come out of that, we're then breaking structure. So when we get this big run, that's telling me, right, that as price punches through this level, look at that really aggressive, that really bullish candle, right? So as price punches through this level, what I'm interested in is the inefficiency that it leaves behind it, which is this, okay? And I'll keep that in red just so that you guys can see it a lot clearer. I'll do it in green because we're bullish, right? So we've generated our high time frame bias based on price action and based on our divergences. We've now confirmed that divergence on a 4-hour scale as well. We've had our break of structure on the 15-minute. Yeah, we've had our shift. We've had our break. So then I'm looking for entries in here, right? And where do I want to target? I'm then looking for key targets as I look left, all right? So what we notice is this liquidity from this higher, right, was taken here. That was swept in this move higher. Now it's come back down. We're saying it's searching for liquidity lower down. We see this inefficiency, and we're saying if that has been swept, right, then we would expect it to find liquidity above here because we also notice that this has been swept, right? Or we're going to be looking in this region here. So we're going to mark out the key liquidity, and we're also going to make an allowance for the order block, right? So that's the last up candle, right? And I want the high volume up candle, which is this. And we'll lay this up as our order block. And this is our 4-hour order block, all right? 15 minutes, sorry. M15. So now we've got clean targets to the upside. So as we drop into this level here, we're looking for entries with realistic stop losses. We don't want our stops to be all the way down here because our risk to reward will be very poor. Then we can drop onto an executable time frame. Now, I run this down from the 5-minute down to the 1-minute because I appreciate that a lot of people don't necessarily have the ability to enter trades on the 1-minute because it moves a little bit too quickly. But what we're saying in here is even if price is coming into this level, right? Even if you wanted to set a limit order on the high of this, you want to take your level, you want to say, fine, if I believe price is coming back and it's going to tag in here with the top side of this fair value gap, where's my first target? My first target is here, right? Here. Because that's already been swept as we move into here, but we know there's an order block. However, we've seen that that's been tapped into, so we can take our target down to this high to be conservative. Now we need to focus on our risk to reward, which as we can see here, if our stop loss is below this kind of micro swing low here, the risk to reward is terrible. But we're also saying we don't really want to see the fair value gap violated too much, so we need to be sensible. If we believe price is coming down into this level, right, we can then look to refine this fair value gap down to what it represents on the 15-minute, which is here to here, right? So as this becomes our 15-minute fair value gap, which I'm going to do in purple, then we can say we can abide by the rules of stop loss when it's based on an inefficiency, which means that we can take the first candle of the 3-candle move. So if I zoom in a little bit for you guys, We see we have our fair value gap here. This is candle 1, candle 2, candle 3. So we can move our stop loss below the origin of this, which is this candle's low. So as we do that, we can see how the bias sets in. We can hold that position, right? And then as we see, we come back up in here, we tag this, we take that out perfectly, and we've got almost a 3R trade there, right? So if market conditions are quite choppy, I typically look to take heavy profit at a reasonable target, right? And then I want to flip my stops to entry, right? So fine, we get our entry taken out here. I've taken 80% of my trade there. It's a nice win. Then we're looking for the continuation of that bias, all right? So that's how we've taken it from a weekly. We look at our market structure, right? So we'll do a very quick top down for you guys just before we finish up the stream, just in case anybody wasn't here for the beginning part of it. So what we've done here is we've marked up our key levels on a weekly scale, right? Now, we've also added in our divergences here for confluence, for which I'm using the B Pro, which just basically just combines a number of other oscillators and then gives you a percentage of all of those combined. We've said to ourselves that we've run a key level here, right? Which was this key low. Now, we expect there to be liquidity below here that could reverse the market. So we wait for this day to close. When this following week closes, and when this following week closes, we create this inside bar pattern. This is the mother bar. This is the inside bar. And we're treating these as ranges. So when we run one side of the range, we're expecting price to run to the other side of the range via the equilibrium, which is the 50% line, which is almost perfectly on where that order block is, right? That order block line. Now, we've marked this up because this is our weekly divergence, which holds a lot of weight, yeah? Then that's what that blue arrow represents, right? So then when we move on to a daily scale and we're doing the same, we're looking for confluence from these divergences. We're simply saying when price runs a key level, as we get here with the mother bar low, right, and the inside bar low, this represents this bullish divergence. So from this candle, we can be bullish and we're trading up into these highs and then the highs of the inside bar. This is our weekly confirmation here. So we're super bullish here because we're saying to ourselves, right, okay, well, if it's on a weekly scale, we want to respect this, and we haven't run the inside bar high at this point, so it gives us another opportunity to get in. This, represents our bearish divergence and the fact that we've now run this level here. So this red dot represents the daily bearish divergence, as does this. The reason we have them on the following candles is we're waiting for that to close, okay? The other things we're aware of here are our fair value gaps, which are these larger grey boxes. This one, which is a weekly fair value gap, and this one, which is daily. We see these as a draw on price when price is trying to rebalance, right? It's trying to find efficiency for the market, right? Because markets want to be efficient. So our premise is we're running key levels. We're looking for our divergences, right? When we get confirmation of those and we're interacting with these key levels, then that is what shapes our bias. We then take that bias down onto a 4-hour chart, which is the lowest time frame that I personally use divergences on. And every time we see a red dot, we're then looking for a green dot. We're then looking for a divergence. So like we get this one here, green dot, bullish divergence, nice trade, right, into these highs. Red dot, following a bearish divergence, we get stopped out on this one. So we're 1R down, maybe 2, 3, 4 up on this trade. So we've lost 1R, no problem. We take that on the chin. We then run these highs. We're still bearish based on our daily divergence. We now get our 4-hour divergence. We get a nice trade down into these lows. So we're then probably at net neutral for this loss with this win, right? So then we're patient. We get all these days, right? All these days of having to wait patient. So we can play any runs of these further down, but if we want to be super safe about this, right? Because obviously when you see these, you could just play these bearish divergences, right? So we're in high time frame, bearish still. We've got this one. We could trade this down lower. That would have actually run into this one. We come down into this level here, which is a fair value gap that we've marked up on the 4-hour, or we can wait and be patient and say to ourselves, right, well, look, we've got our weekly and daily divergences, our high time frame ones here. We then match that up with our 4-hour. That's when we're walking into our higher probability setups. Now, we had our daily divergence here, right? So that's closed. From this moment, we're bullish. We then have that preceded by our 4-hour bullish divergence, which is why we became bullish on this scale. Then we drop to our 15-minute chart. From here, we're looking for the shift, we're looking for the break of market structure, and then we're looking for price to return to an inefficiency, which allows us to gain an entry on the lower time frames whilst having clean upside targets, which obviously we set at this high because this high here had taken out that high, so that liquidity is gone. This remains because it's our order block, right? So price can still draw into that, as we can see here. Price has then taken that liquidity and we're selling off. So at the moment, we're still in a bullish bias for this on a short-term basis. And why is that? Because we've run liquidity at the lows, right? As we discussed. We've come down here, we've taken out liquidity below that mother bar, and we've taken out the inside bar. We've now come up, markets rebalanced this fair value gap here on a daily scale. We've now drawn down into this order block, right, which is this last, let's zoom in for you here, which is this last down candle here before this impulse move higher. So we've drawn into there, and we're saying if there were buyers in there before, we expect there to be buyers in here again, right? But we don't just want to blindly enter. We can wait for our divergences. We can wait for price action to develop. And then when we look at this in terms of being on an executable time frame, just so that that's all got context, just turn these off very quickly. Then what we're looking for here, as we've seen, we refine this down. We've refined this. We've now refined this inefficiency onto the 5-minute. Price has drawn down into our levels, which gives us our entry opportunities. Now, the last thing that I want to cover is what would I look for as an entry opportunity. So I would do this on a slightly lower time frame, but I'm looking for a sweep, right? So price has drawn into our fair value gap. How do we know where to enter? So we need to see a low taken out by another low, right? So this low comes down, takes liquidity below this. Then what we want to see is the origin of that move lower, which is this high, broken. And I have a funky little name for this. I just call it a breaker line, which is just something I made up. It's nothing that you'll find in books and bits and pieces. But for me, my trade entry is really, really nice and simple, right? I'm looking for price to come up. When we get this displacement, right? When we get this impulse move through, it's showing us this punch move that price is looking to move higher, then I know we've taken liquidity from the lows, this low touch here, or you could have a deeper retracement. When price closes back above, when we get the close above our breaker line, that's when we would execute our trade, right? Not just a market order. I place a limit order on this breaker line, or on a lower time frame, I look for a retrace into a fair value gap. But a nice simple way to do it, right, is to have this level. We don't want to see this level lost, right? So we're refining this order down even more. This was our entry on a higher time frame, right? Or on this time frame, if we're talking about entering on the upside of this fair value gap, if we're looking for a more precise entry where we can refine our R, our risk to reward, then this is what we're doing. So our entry triggers on this candle here. Our stop loss goes underneath this low, right? Hopefully that makes sense, guys. So we've had our market structure break to the upside. Price has come up. We've taken liquidity from the low, broken above this high, right? Now we've entered on the retest of this. So that's our entry. And our target is going to be the same, right? So now we've got a 7.2R trade where this one was affording us a 2.93. Now, something you need to be aware of when you're scalping or you're taking these lower time frame trades and you see these larger R's, which look very, very attractive, is you really want to make sure, and let me just delete this one for a second. I'll leave it actually. I'm going to finish on this, guys, right? Because a really good buddy of mine, someone I work with at the Bird Nest called Razoon, who's a wonderful trader, you should definitely check that dude out. He has created this wonderful piece of kit called the Position Size Manager. I just want to run through this with you very quickly, right? Because you need to be thinking about trading fees when you're scalping, all right? So if I take this on this scalp, the 7R scalp that we did, right? This is our entry. This is our stop loss. And this is our target. Now, let's just assume we're going to cash out everything at our main target, right? Now, I know you're not going to be able to see that too well here, right? But this is default. It's just set up on $1,000 account, all right? You can do this on a $100 account. Do it on $1 million account if you want. It's all the same principle. For me, my risk is set at 2%. If I'm counter trend trading, I drop that to 1%. That means that I want my risk to be $20 in this case, right? If I lose this trade, I don't want to, my risk, this stop loss on the smaller one has to be $20. Same on this one, always $20, right? So this tells me what my position size needs to be. So for my stop loss here to just be $20, for my risk to be $20, my position size needs to be 8,396, right? Now, that means that if I win this trade, I can take $140, which is a really nice return of 16.75%. However, what I need to factor in is I'm going to get charged fees on this. And depending on which asset you're trading, how long you're holding it for, what margin fee you're paying, your funding rate, obviously you're paying your make or take a fee. So it depends how you open on the market. I always allow as a minimum 0.3%, right? So if I'm allowing 1% here, that's $83. Yeah. If I want to be super conservative, I can halve that and say maybe it costs me $40. Yeah. So $40 here, or if I drop it down by a third, then I'm looking at like $26 or something. I need to make sure that when that fee's taken off of that, it still makes it a profitable trade, which it does, right? But please also remember when you're playing with these larger position sizes, and let's say for argument's sake that actually that was, let's say it's half of that, so it's $40. So $40 off of this means you've got a $100 profit. Nice. Still a big chunk, but still nice. However, you need to remember that if you lose this trade, you don't just lose your $20, you also lose the $40 in fees from here. So your loss becomes $60. All of a sudden, your real risk to reward becomes a lot lower. Okay. Now, if we click on this and we adapt this to this larger trade, right, for which our entries here and our stop loss is here, because there's a larger percentage here, right, then actually what you'll notice is our position size needs to be a lot less. Yes, our earnings are a lot less. We're down $57, but actually, if we're taking 50% of that, our position size fees are only $15 compared to 50 or 45, right? So just one thing to say, because I get a lot of questions about this in terms of scalping and people saying like, God, I've been hitting these kind of like 2, 3, 4, 5 hour trades. I'm going to my account. It's really not reflecting the profit that I thought I would get. And that's because of the amount you're paying in fees. So please do remember that when you're managing your risk with these, you want to always make sure to check out the fees as well that you're going to be charged. And you can do this by going on really good exchanges like Bybit, Binance, etc., and just type in margin, or go into Google and type in margin fees Bybit or margin fees Binance. It will give you a list of all of the different assets they have, because they also have different margin borrowing costs. All right. So for example, BNB is particularly penile to trade. So you're going to pay a lot higher for that. You pay 3-4 times more in fees than you will trading Bitcoin, for example. So, guys, I know this has been a little bit waffly. I wanted to get in a good session with you before Christmas. Obviously, I'm not going to be back on next Monday because that's over the Christmas period, but I think I'm going to be back with you on Wednesday. So I hope you guys have found this interesting. I'm sorry if it has been a bit slow for anyone. Just wanted to make sure it kind of gets the point across. I really want to make sure that when we're diving into these sessions next year, I'm looking to do some live trading sessions with you guys as well, and do some live trading across some different platforms for the Nest. So I want to make sure people understand where I am with the strategy, how I look at the markets. Again, I'm not suggesting that you guys copy this, right? It's just to give you an insight and how I trade it, and I hope it's stuff that you guys find useful. So I'd just like to close out by wishing you all a really amazing Christmas. I think everyone, after the few years that we've had, could do with a little bit of a break. Stay positive, have a wonderful time, really try and just relax and get yourself some good headspace. I use it personally to backtest a lot. I love getting back into my books. I love to study, love to read a good book. Then that way, when I come back in January, I'm really refreshed and really ready to pump. And the other thing I'd say as well is that we've got our 5th anniversary coming up on the 27th. So if you see any bits and pieces about that, please do come and get involved. It would be really, really awesome to have a load of you there. So have a fantastic Christmas. Send you guys loads of love. And I look forward to catching you just before the new year, in fact, on the Wednesday, and then again in the new year. Have a good one.